Hello, it's Chad Lubin, Cross Country Mortgage. Hope you've had a fantastic week. I wanted to give you a market update, and there's always an inflation number we need to look at to understand our economy right now. The number one thing that is driving mortgage rates is inflation. Don't get tied up into thinking the Federal Reserve controls mortgage rates. They don't. Remember, mortgage rates are a function of what mortgage bond traders think the next 6 months to a year is going to look like. So a lot of people ask me, hey, how did mortgage rates go down after the Fed increased the prime rate? Well, it's simply because traders took that as a positive sign that our Federal Reserve is going to get inflation contained within 6 months to a year. So remember, they're always looking out 6 months to a year. When it happens, they've already factored all of that stuff in. The only time the markets move is when there's a surprise, right? So when something surprises the market and it went against what traders were expecting, either for the better or for worse, mortgage rates are going to move in that direction, just like the stock market. So think of interest rates as a bond selling on Wall Street, and it moves up and down just like a stock would, Costco stock or Apple stock. So I just want to make that super clear. Some great news out there on inflation numbers. So we received the Consumer Price Index report. I'm going to share my screen with you. And if I look up, it's just because I'm looking at the slide. Know that the headline number month over month, which is CPI, Consumer Price Index, was flat. Right. So that's a good sign. Finally, a stop of increase. And when we look at that year over year, what happened is that replaces July of 2021, which is at 4%. So taking that 4% from July and now adding July of 2022, it brought the number down to 8.5%. Traders were expecting 8.7. So we saw mortgage rates improve on this information. Okay. Now there's a couple other things to look here that's important to our economy. Rents. Remember, people are in leases that were locked up maybe last year, even back into 2020. A lot of people signing 2-year leases, right? So that will catch up. That's a lagging indicator, right? And it is higher, and I believe that will continue to soar. So it's still a great time to buy a home because you're locking in your price and your fixed costs now. And rents, I just had a client come back to me at 28% increase on their rent. You will continue to see that. So if you're a renter, don't think that being on the sidelines and not buying a home, that inflation's not going to impact you. It will through your rent when you see your next lease. And this might not sound politically correct, but landlords are businessmen and women. Their job is to make the most money off their investment. They are not a good business person if they do not increase rent during these inflationary times when the costs of everything are more. Energy costs were down. That's a really good sign. Obviously, this drives our market. So let's hope that energy costs keep going down. Gasoline down really helps out. That will help these kind of top two things, right? So it's a mixed bag, but mostly positive of everything that came out Wednesday. And if I show you the chart of mortgage rates, remember the higher, they call these Japanese candlesticks, the higher they are on this chart, the better the interest rate. So the good news is this purple line here, which we've broken above a few times, we're starting to see us peek our head up here. So if we could break up to this line, that's about another 0.25% in interest rate. Lastly, do not let the media spin these numbers incorrectly to you to think the housing market is suffering. They're using numbers off of 2020 and 2021. I have put RIP 2020 and 2021 on a lot of my materials. It was fake. It was fictitious. It was caused by, I mean, it actually happened, but I don't expect it to happen again. Those rates aren't coming back. I can't say never again, but they're not coming back anytime soon. I think 10, 15 years before we'd see lower rates like that. Could be wrong. But also when we remember that we also had the government pumping money through quantitative easing, which is buying of mortgage bonds to artificially keep interest rates low to stimulate the real estate sector. That does happen from time to time, but it went on too long. And I believe they pumped too much money in, and now they have to pull that money back out and correct the balance sheet that they have. And no, that's what's going on right now. So defaults, which means late payments or foreclosures on a mortgage, is at 23-year lows. The housing market is very, very stable. The average equity in a home right now across our country is 52%. That means that there's lower of a loan than half of the value of the home. That's record equity in our country. People are not going to give that money back to the bank and foreclose. That will keep supply dependent on new construction, which we all know is a struggle due to supply chain issues that are getting evened out, but still there. So it's a very strong housing market. I want to leave you with one last thing. We ran these numbers for someone the other day, and I've done this a few times, so just be cognizant. I'm a big stock market investor, have multi-millions in the stock market, also in real estate. And what I can tell you is the stock market and the real estate market performed about 40% in 2020, 2021, right? Well, the stock market has pulled back 20-30%, and the real estate market has continued to increase. So Core Logic has forecasted for about 4.5% appreciation across our country. When we look at that on a $400,000 purchase, right? Remember, your investment is your down payment plus closing costs. So if someone puts 10% down, call their closing costs, for round numbers, it's a little high, but $10,000, and then 10% on 400,000 would be 50,000. Right now, remember, the appreciation is off the total purchase price. So if we get 4.5% next year, that's $18,000 in appreciation on your home. Well, your initial investment is 50,000. That's 36% return on your money, right? That's a spectacular return. Now, I've had stocks perform better than that for 1 year. I've had stocks perform better than that for 2 years, but never for 3 years have they went on a 36% per year tear. It just doesn't happen. That happens within real estate. That's called leveraging the bank's money to have a good investment for yourself. So people will argue with me, yeah, but you got to pay the monthly mortgage payments, right? Well, what do you think you're paying for your landlord? I've been a landlord. I have a lot of clients and friends that are landlord. I promise you're paying your landlord's interest. You're paying your landlord's property taxes. If it's a condo or a townhome or in a association, you're paying their monthly assessments. Now, you might not pay all of their principal balance down on the loan. They might have to chip in. I see that on some numbers, but you're paying all their costs, right? And the money to pay their principal down is cash flow for them, creating equity in that home. So do that for yourself. Stop paying your landlord's mortgage. Start paying your mortgage. And just know we're happy to run any of these numbers for you. Real estate is the best investment I've made. It's created wealth for me. It's allowed me, over buying and selling now 9 properties, to live in my dream home, to give my family what I want. But it started back in 2004 when I purchased my first home. So we'd be honored to help you. Any of our agents watching this, we'd be honored to have this conversation with any of your clients. It's still a great time to buy real estate, and we're here to help you do it. 312-731-4939. Chad Lubin, Cross Country Mortgage, 312-731-4939.